This is Trepwire Week in Review for week ending April 15th, 2022. I'm Martha Kocher with Trep, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with our experts Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, earnings kicked off with the first look at effects of geopolitical uncertainty and a bunch of economic data to digest. With all eyes on inflation, both consumer and wholesale prices surged last month. Retail sales rose less than expected, and mortgage rates reached 5%. And a surprise to the upside as consumer sentiment rose in April. Manus, it's a short trading week because of the holiday, and markets did seem to react to the batch of data that was released, and it wasn't necessarily welcome.
Thanks, Martha. It's great to be back after a 1-week hiatus. Great to be back in the saddle this week. I always hesitate to talk about it being a short week on either Columbus week or Good Friday week, because it seems like those days are half and half. And if you're one of those people that have the 5-day work week this week, our apologies to you. I think a Trep will be closed tomorrow and take advantage of the long weekend. To your point, Martha, I think it's all about inflation. That's been everything this week. And as footnotes to that, the beginning of QT, quantitative tapering, which is the unwinding of the Fed balance sheet, reducing the flow, which had been to purchase treasuries and mortgage-backed securities for the last 24 months. That will now be reversed, and the portfolio will be allowed to run off. So let's dig into this a little bit deeper. On the CPI side, expectations had been for 8.4%. The actual number had been 8.5%. The markets didn't really react all that negatively, and I think that's because a day earlier, the White House had been talking about how catastrophically bad the number was going to be, and I think people were relieved to see that 8.5% number. The core number actually even came in lower than expectations, which was a nice relief. On the PPI side, explosively higher on the headline number, 11.2% print versus a 10.5% expectation. Again, core was lower than anticipated. So that's what everybody is watching this week. One thing that came to my attention, which I thought was really good, we talk about this writer quite a bit, Lisa Belfus, who writes for Barron's. And I learned after trading emails with her this week that I had been pronouncing her name incorrectly for several months. But she had a line in her column this week that said, for each $1 trillion in quantitative tightening, meaning for every $1 trillion that the Fed burns off, sells on the open market of treasuries and mortgage-backed securities, equates to a 50 basis point hike in interest rates. Over the last 2 years, we've had about $3 trillion in purchases. So if you do the math, unraveling that over the next 12 to 24 months would be 150 basis points of additional tightening. So if you go with the thesis that the Fed is right, that they're going to raise 11 times, and the terminal rate would have been 275 on the Fed funds rate, and you add 150 basis points on top of that to the 10-year, you're talking about a 4.25%, 4.5% 10-year. And that gets alarming because when you add a 2% spread on new lending for commercial real estate, you're now talking about rates in the 6.5 range on commercial real estate, which is about double where we were at the trough.
Yeah, I think this week they actually announced 30-year mortgages crossed over the 5% threshold. So we're starting to see that play out. I think we haven't seen the cool off in home pricing. We've talked about this a little bit the last couple of weeks that the demand side is still significant, even though rates have been creeping up. I think the one thing that's maybe a little underreported is that a lot of the closings that are happening right now or that have happened over the last 30 days had interest rate locks in place that probably protected the buyers from those downside risks. So as interest rates have gone to 4, now 5+%, people are still transacting in a technical sense on deals where they locked in interest rates at 3.5, 3.75. And so I saw some stuff on CNBC today where they were talking about, the impacts of a 50 basis point increase to mortgage interest rates and what that does to purchasing power. And we've talked about that internally at Trep in some of our Tuesday morning meetings. At some point, it's just basic math. if a borrower can only afford X a month in payment, and interest rates continue to increase, the purchasing power is diminished, and it gets diminished relatively significantly as those rates go up. We talked last week, Manis, there was some other Fed commentary that I think said they were about 300 basis points too low to actually rein in inflation, which would actually tie in really nicely with what you've just outlined on the 50 basis points per 1 trillion plus the 225. So I think it's interesting to see. I was going to comment a little bit on the inflation too. Gas prices peaked at like $4.33 a gallon back in March. We're about 30 days post the peak. It looks like this last week, according to AAA, gas prices were down to $4.10. I think what's interesting here is the White House has done a lot of, kind of moving of the levers to get those prices down, because those are the most notable in the inflation numbers. But I don't know if there's anything that they've done that will over the long term really, hold those prices down. So it's almost like a PR campaign. You mentioned that they came out a day before the numbers were released, and it was like the shock and awe of this is going to be the worst number ever. Kind of bakes in a little bit of a buffer when they come out with 8.5, when people thought it might be 10. I'm still not convinced that they have this under control. The numbers look good now, but it's almost like that shadow delinquency we talked about in the CRE market, where people were able to use reserves and other things to get current. And we weren't sure if that was going to hold until, a little bit more time passed.
Yeah, I peeked over at my CNBC squawk that's over my shoulder here. And I think they updated it in the last hour, and the 30-year fixed is now 5.15. The yield on the 10-year rose 13 basis points today, up to 2.83. The yield on the 2-year, and the 2.83 is a multi-year high now. I think we hit 2.82 or so overnight 3 or 4 nights ago, but we hadn't been that high during a trading session. The 2-year was up 11 basis points today to 2.46, which isn't quite as high as its peak in this cycle. But those are substantial increases. In the 2-year, we're talking about 200 basis points over the last, I would call it 12 months or so, give or take. And on the 10-year, we're probably talking 130 basis points over the last 5 months. So that is meaningful and something we continue to watch. To your point about gas and oil, Lonnie, I'll go back to that. I think the parenthetical there is, I think investors got a big sigh of relief that the core number was less for both CPI and PPI this week on Tuesday and Wednesday. And I do think that those beats were a function of oil being corralled, which you pointed out was somewhat artificial by the releasing of the strategic reserves and other things. But if it fell, and CNBC referenced this during the week, if it fell by 1%, it means that food was probably up 1% or up 2%. And that's the thing that concerns me the most. In fact, I think CNBC said food was up 9% last month versus a core of about 7%. And that's the part that to me is heartbreaking for families that are struggling to put food on the table to begin with, and then seeing prices go up 10 or 20% over the course of 6 months. That's hard. And I'm grateful for people that stock food banks and pantries and so forth during times like this.
We talked a little bit about earnings at the beginning. There are a couple, we have a lot to talk about today, but there are a couple earnings I think that you were watching. Which ones were the most interesting?
Well, the two big ones this week that really seemed to get people's attention, one was JP Morgan. Their stock fell after the release of their earnings. The expectations were quite muted going into it. The expectations for what they would post on the top and bottom line were pretty muted. They came in above those muted expectations, but even so, the stock fell off about, I guess, 4 or 5% over the last 2 days. The big headlines there were, number one, the bank taking a $500 million loss from running off certain operations in Russia, which I think is going to be probably par for the course for most big banks, that they'll be posting losses on endeavors that they had going there 6 months ago. And the other part, the big headline, was Diamond saying that the next several months and next several quarters should be rocky, that we should expect volatility. And I guess that spooked some people, but I'm not sure why. When you have PPI running over 11%, interest rates surging, war in Eastern Europe, it's hard not to see that there's going to be volatility down the road.
Yeah, it's almost like the markets wanted Diamond to say, "Oh, it's going to be fine." But to your point, all of the macro indicators are not that. I mean, I think he has to take a slightly hedged position and say, we see the same turbulence that everyone else is predicting. And I think what's interesting is J.P. Morgan. I think they added a significant amount. It says 902 million in credit reserves for potential loan losses because they feel like there's higher probabilities of downside risk. So revenue numbers weren't terrible for them, but to your point, they see the storm clouds on the horizon. They're taking maybe a more concerted effort on the reserve side. I think Wells Fargo was the other that reported. It was interesting, lower than expected first quarter revenue. They attributed that to the mortgage lending, which we've talked about a little bit on the intro today. But to Wells, they quantified that at about 33% drop off on the home mortgage side compared to the previous year. And they attribute that directly to the mortgage rates having increased. And they took a little bit of a slight different approach when it comes to the reserves. They actually, boosted some of their earnings numbers because they decreased, about 1.1 billion in allowances for credit losses. So interesting to see the two different approaches there. I think Diamond's in a unique position because he's kind of the face of JP Morgan. Wells Fargo seems to be a little less in the market in terms of having a single point of contact as the voice there. But I think we'll start seeing this in the broader set as well for these banks of, they have to kind of walk a tightrope. If they say it's doom and gloom, that's bad for business. That's bad for them. That lessens consumer sentiment. If they say it's all roses and things start to fall out, that's not great for them either. So I think this is one of those areas where we're going to hear, storm clouds. We're going to hear potential for higher defaults, et cetera, but not really anything too concrete in my estimation.
Yeah, the one thing that has been really a 20-year tailwind for banks has been loan originations, right? With rates marching lower year after year, really since the 1990s, they could always count on, with very few exceptions, a huge origination book every year, which allows them to capture origination points and fees and so forth. And what you may see right now is just a complete reversal of that, which may weigh on earnings down the road. What we have seen in those few times where banks have seen pauses in originations is banks are very quick to lay off their mortgage servicing and origination teams. And we've seen cases of single tenant assets in the Carolinas and in other places where a bank's origination and servicing team will be located there, occupying a 150,000 square foot building. And then the next day they're gone. They just say, we don't need the staff anymore. We're not making loans at the pace that we were before. So it is something to watch as time goes by. The other big earnings we saw this week, which was kind of alarming, was the Bed Bath & Beyond, which the big headline there was a 9-figure loss, $100 million plus, due to lack of inventory and supply chain issues. The firm said that they were not able to keep as many things on the shelves. That crushed their sales, and the supply chains were really a problem over the last quarter and a half. And the stock sold off about 20% in the immediate aftermath, and then fought its way back. I think it was close to flat by the end of the day yesterday. But the real headline was, for them at least, these supply chain issues are real.
Yeah, and I think we're going to start seeing more of this for these big box retailers because they're in a precarious spot of, having to try to keep large quantities of inventory across a broad range of different, consumer goods. It's interesting, Bed Bath & Beyond, they're still holding on. I mean, I think we've talked about Bed Bath & Beyond for the last 5 or 10 years about the troubles they faced. It sounds like, based on the way the stock sold off, man, is that instead of sending consumers the 20% coupon, they sent it to the investors. So they were cashing in on the Bed Bath & Beyond 20% coupon on the stocks.
There you go.
And we did see Delta announce their earnings, and it was a little bit of an uplifting story because it sounded like they're doing well in spite of the increase in fuel costs, and obviously it's rather significant if you look at it year over year.
Yeah, Delta is interesting. I can tell you, as you guys know, I've been on the road like 10 of the last 12 weeks. My new address is row 12, seat C. And so I've seen firsthand how the travel market's picked up. But it's really interesting to see the increase in jet fuel. They said it was about 160% annual increase. So for them to have, reported good earnings at the company level with those increased costs, It'll be interesting to see if that cost remains the same, if they're able to still hedge and make that work. But corporate travel sales, they said were around 70% recovered when compared to 2019. And 90% of its corporate accounts expected travel volumes to increase in the second quarter as more offices continue to reopen. So I think it's good news for Delta. We've had some rough times on the airlines, kind of like the hotel industry, but it seems like they've maybe finally turned a corner and things are looking a little more stable for them.
For me, that number is shocking. I have to say that 70% return to normal and the 90% expectation just seems to be so pie in the sky. I was sharing thoughts this week with one of our Twitter followers, Donut Shorts, and it's of a piece of what we talked about maybe a year ago or so, which is my belief that these CFOs at the large firms have become addicted to the savings over the last 2 years of not putting guys on planes every day for a meeting or two. And, my updated thesis on this is that the conference business will come back where you could meet 75 clients over a 3-day span. That will always be funded. But I am still a believer that putting people on planes frequently for just a meeting or two, I think that's going to be a tough slog before that comes back in full, but time will tell.
So let's start with office. We've got a lot of office news this week. I first want to give an early shout out to BB Doggett, who commented to us on Twitter and highlighted a story about office deals in Dallas, LA, and Denver that was in Bloomberg. And essentially the story is about a tale of two cities, as it were, for Class A office properties compared to the less flashy offices that in some cases the landlords have to offer sweeteners like free rent renovations and other extras to attract tenants and owners.
Yeah, this is the point in the cycle for the office market where we bring back the old bifurcation terminology. So this is clearly a bifurcated market, the haves and the have-nots. Class A seems to be doing really well, the others not so much. I'm working on pulling some data together for a blog post that we're going to put out here in the next week or so, looking, effectively at the office struggle. So we've talked about this for a while, but just to give some context and a little teaser to the content you'll see here in the next week or so, there's about 6.4 billion worth of maturing office loans between now and the end of 2023 that also have debt service coverage ratios of 1.25 or lower. So those are going to be really challenging to refinance.
Yeah, I think that's really the story for CMBS. I think I said this 2 weeks ago. If I'm looking for excess yield in CMBS, I am looking at interest-only bonds with the likelihood of extension. I think that a lot of these things go down that mall path, which is extend and pretend. Right? We've seen this over and over again. And I think when a guy is cuspy, meaning he's got a DSCR that's kind of borderline refinanceable, and all of a sudden he realizes he's not refinancing into something with a 3 handle, he's refinancing into something with a 5 handle, that all of a sudden it's time to talk to the special servicer and see if there's a 2-year extension and something like that. So that's, I'm not a trader, but I think if I were, I would be looking at these IOs, and salivating over the prospect of them extending. I'll throw something out in there also to follow up on that BB Doggett tenacity thought and to what Lonnie was saying before about the haves and the have-nots. And this was an interesting story for me from Commercial Observer. I thought this was a brilliant analysis. They were talking about One Bryant Park, which is right by Grand Central Terminal, several 100,000 square feet of space. It is the home of the Bank of America trading floor. LEED certified. The owners, who are the Durst organization, have pumped millions and millions of dollars into this to meet the forthcoming environmental mandates. And even with everything they've pumped in, it appears that when these mandates take place in 2004, and in New York, it's called Law 97, that unless they improve on what is already a highly intense capital spend, they're going to be on the hook for millions of dollars of fines every year because they're not meeting the environmental mandate. So just to run through what they've done in this building, they've added their own cogenerational plant, whatever that is. They have a geothermal heating and cooling system and underground ice storage. I can only imagine what that costs. And even after that, because the B of A trading floor, which takes up 5 floors, is so energy intensive, that they're not going to be able to meet the mandates and they're going to be fined extraordinarily. So the reason I bring this up and the reason why this matters is if they can't make it work, how is that guy in the B and C class building who hasn't pumped millions or tens of millions of dollars into a geothermal cooling system ever going to meet the mandates of Law 97? It just goes to show that either they're going to invest incredibly heavily in these things, or they're going to decide it's not economical and they'll throw the keys back. But either way, it's something that could really, really pull the rug out from under many landlords in New York over the next 3 or 4 years.
There's no, ands ifs about that. It's just a matter of when that goes into place, we're going to start seeing it fall out. I mean, I think in that specific example, the rent reimbursements have to come into question, because they're not going to be able to just proportionately share those additional energy costs with the entire building when they know that 5 floors are generating, the exorbitant amount of energy consumption and costs there, in addition to the local law, 97 penalties they're going to have to pay. So in addition to the 6.4 billion of maturing loans with the 125 debt service, over half, 3.5 billion of that has occupancy already below 70%. So to your point, Manus, these things are going to fall off a cliff. And I think the challenge is, and we can spend some time talking about this in maybe an upcoming episode, but there's not a lot of secondary utility for some of these buildings. They're really old. They're not going to make good, conversion properties to something other than office. And if they can't, cost justify these millions of dollars to be spent to get them up to energy standards, especially in New York, it's going to be really challenging. So as far as the blog post goes, the 4 largest MSAs that are impacted, you could probably guess it's New York, Chicago, DC, and Houston. These are ones where, just by definition, 125 or less on the debt service, upcoming maturity, 70% or less occupancy, interest rates are going to kill these guys. It's going to make that a much accelerated demise. So more to come on that. I have a few other office stories that we'll run through real quick. ExxonMobil, we talked about this, not this particular deal, but about Exxon a few weeks ago. They've been really proactive in transitioning their workforce down to their Houston headquarter campus now. So the latest turn in that event is that the Irving office campus, which is a very large campus, it's about 365,000 square feet on 200 acres, is up for sale now in the Las Colinas office market. So for those that are maybe not familiar with Las Colinas, it's just outside of Dallas. It's a suburb, and it's really high-end, nice office buildings. There's a lot of them. It has nice size homes around there, high quality employee, talent base for employers, good access to the major cities, both Dallas and Fort Worth. So it's been a very active marketplace over the last, call it 12 months. What's interesting is Dallas and Fort Worth have both been impacted by the ExxonMobil move to Houston. So a few years ago, when they acquired XTO Energy and rolled them up under the ExxonMobil, XTO was the largest tenant in Fort Worth. And so they've gradually moved all of those employees down to Houston. Now we're starting to see it in Dallas and in Las Colinas. So more to come on this as that property trades. But it's interesting to note that Exxon is really, taking advantage of maybe that hot office market in Las Colinas to move those people down to the Houston area.
And Lonnie, Manus is a big believer in the theme. So you need to call this section a theme. I think he gave us one that I like. You already know Green Shoot and Crabgrass. This is the broker start your engine theme, which we probably need a little engine sound, Haley, to begin that segment all over again.
Well, since you guys know I restore muscle cars and drag race, I'm all about start your engines. And in Texas, we have, the F1 track down in Austin, and we have, the Texas Motor Speedway, which does the NASCAR. So I think the broker start your engine. I'm well equipped to handle that section, and I like the theme. So Texas legend approved. So let's look at a couple of others here. Going out to San Francisco, we talked about Union Square last week. And interestingly enough, I actually saw an It's Sugar storefront this last week. So they do exist outside of San Francisco. I took a picture. I meant to text it to you guys, and I just haven't had time, but I'll send it over. I saw one in the wild. In San Francisco, Wells Fargo is going to sell their downtown office building and renew a big lease at another building. So a little story on this. they're preparing to list the 13-story office building it owns and occupies at 550 California Street. Wells Fargo has industry experts that are close to Wells Fargo say that property is about to be on the market. They said that Wells Fargo will execute on the strategy in the next month or two. And they're also going to renew a massive lease at 333 Market Street. The terms were undisclosed on that one, but it does show that they're not totally giving up on the San Francisco market. They're signing a large lease, but maybe trading out of a building that they've occupied there on California Street.
On that point, I think it's of a piece, which is, we've seen this over and over again, which is people recommitting to cities, but for less space than we had before. We're going to talk about another story in Jersey City in a short period of time about that as well. And you're happy that they're not uprooting themselves completely from the city, but selling 550, it sounds like they're going to consolidate from 550 to 333 Market, make this building available. And I think this will be an important benchmark for that city to see where this thing trades, right? We'll talk a little bit more later about Twitter and Musk and everything else, but that city, heavily hit by work from home, high expense, high quality of life issues. And I think I'd love to see 550 California get a premium price, but whatever it is going to be a real bellwether for the Bay Area.
Yeah, it's interesting too, man. They're choosing to sell a building instead of consolidating some of their workforce into that building. So it's like they're not abandoning San Francisco, but by trading out their ownership stake in a building and leasing somebody else's building, it maybe gives you some perspective on what they think about the prospects of that market long term. So it'll be interesting to see. To your point, hopefully it sells for a good price. We all are better when San Francisco's real estate market is good. So more to come on that. Last one here I was going to hit on. Now that the engine's good and warmed up, hybrid work means Thermo Scientific in Wilmington, North Carolina, has different needs for its office HQ. So Thermo Fisher Scientific is considering selling its downtown office building, what's formerly the headquarters of PPD, which the company acquired late last year. So 4 months after officially acquiring the headquarters, they announced it's exploring opportunities to sell Wilmington's tallest building. The scientific service leader is embarking on a multi-year effort, which include plans to seek new office space in Wilmington. The comment here was that this will enable the business to better match current and future workspace needs with flexible work models. And this is one where, we don't see typically large capital investments like buying real estate at this level and then selling out of it within just a few months. It creates all kinds of complications for companies that do that, but it does seem like that they're looking at, what their options are. For Wilmington, it seems positive that they're looking at, additional space there in that market, but it seems like maybe this building as currently constructed, and this goes back to the bifurcation we talked about, probably just doesn't meet the needs of their current workforce.
Well, now that we've started our engines, Manus, you're feeling a little nostalgic and it's time for a walk down memory lane.
Yes, Lonnie is the fast car guy. I'm more of the stroll through the park, kind of indifferently before heading back to my multi-year-old Honda that chugs back down to my home. So Lonnie runs much faster than I do. A couple of things that we saw this week. Last week, I know that Lonnie and Martha and Andrew talked about that big Stanford office that was once valued in the $300 million range and had been sold by Charter Communications for something in the $70 million range. It was a painful memory. We have one painful memory and one good memory today. I'll start with the good one. 770 Broadway in Lower Manhattan, or I should say it's more like kind of that Astor Place, Greenwich Village part of the city. It once backed a $353 million CMBS loan from 2006. Why did this pop up on our radar this week? Globe Street's Erica Morphy was reporting that Facebook is increasing its footprint in that property by about 30%. They're taking another 300,000 square feet in that office, which we love to hear. It's another sign of the revival of New York. And anytime that happens, we feel good. So good on Erica Morphy for that one. Another memory we saw this week, Opal Holdings acquired 263 Schumann in Naperville, Illinois for $73 million. CMBS vets might remember this as the former Office Max headquarters. the property once backed a $49 million loan that took a nearly 90% loss in 2018 after OfficeMax pulled up after I think they merged with Office Depot and moved their headquarters down to Florida. That vacated property sold for about $8 million. Now, this week, Crane Chicago's Danny Ecker was reporting that it has resold for $73 million. So a little bit of a happy ending there. Terrible story for CMBS holders, but we've now seen this property rebound to 10x of where it was sold for a couple of years ago. And it just goes to show that sometimes even these most distressed assets, there's residual value for those willing to kind of dive in, get their hands dirty, and reposition the property. So good on Opal Holdings for betting on Naperville, Illinois.
Yeah, Opal's kind of been on a shopping spree lately. So my brother actually lives just outside Naperville and Bolingbrook, and I know it's a pretty active market up there. So it's good to see, to your point, Manus, this building in particular coming back. But Opal, I think they bought a 50-story building on Wacker Drive, the Wacker Drive Tower, and Caterpillar's Deerfield headquarters. So, they are going all in on this broader Chicago marketplace. So about 650 million worth of office buildings. Kind of a unique story on this 263 Schumann Avenue. This was one that they split off the ground lease and the building. So they bought the leasehold interest and kept the ground separate. So we've talked a little bit about that on the pod. There's inherent benefits to doing that in some scenarios. You can still generate ground rent revenue, potentially lower your cost of capital on the building side. So this is one that actually, if you dig into it, has a little bit, for those of us data nerds, this one's one that has a little more than just the headline number.
We'll close out with one more office story. I know we spent an awful lot of time on office today, but I didn't want to miss this one, which was a trading alert we sent out on Wednesday afternoon for our CMBS readers, which potentially market moving for certain 2018 CMBS bonds. The story revolves around Jersey City and 90 Hudson Street. Lord Abbott, the money manager, occupies about 60% of the space and pays about 66% of the base rent on that property. They announced that they would be moving from 90 Hudson to 30 Hudson in Jersey City. Angle number one is, like so many other stories, they are downsizing. They're reducing their footprint by about a third, from 260,000 square feet to 180. The bigger issue for CMBS types is you now have a $130 million loan that will see a 60% vacancy at some point in the next 2 years. That Lord Abbott lease ends sometime in 2024. And certainly that gives the owners time to refill it. And Jersey City has been a very resilient area over the years, a very strong magnet for financial services firms. So by no means does this mean the end for 90 Hudson Street as a loan, but a $70 million piece of that loan is 6% of a 2018 deal. And it does warrant investors footnoting this and watching this as it plays out over time. That story, thank you, Real Estate New Jersey, for breaking that story for us.
Yeah, it'd be interesting if we actually created a little tracker to, monitor these downsize, office tenants, because we've talked about them in the last couple of weeks. There's a growing number of them. What'll be interesting to see, Manus, on this one is when you have that much square footage become available, even if you find somebody that wants the space, to the owner, there's increasing costs because they have to turn it over. There's going to be tenant improvement with supply chain constraints and labor costs, like something that maybe was less of a headache for them a few years ago. Now there's all this other administrative red tape that they have to go through just to manage that process, and not considering just the cost of turning, those floors into a new space for somebody else to occupy.
Not to mention, they may need that geothermal cooling tower sometime between now and 2025. That's losing Lord Abbott may be the least of their problems. We'll have to wait and see.
I'm nervous about that ice room down below the building. Like, what else are they storing down there? I mean, is that going to have some mafia ties soon?
Beer.
Yeah, it's going to be the place you want to be when the big one hits.
Yeah, right. And I think if you have been under a rock, you haven't noticed stories that include Elon Musk and Twitter And it's been an interesting development this week, but it started early this week with a story that we noticed actually because of an impact to a CMBS tie.
Yeah, I mean, the story may have changed dramatically in the half an hour we've been speaking on this podcast. Already we saw Musk take a 9% stake in Twitter and then be asked to join their board and then either decline to join the board or have that offer rescinded. It's not really clear. And then him joking that their office should be turned into a homeless shelter because nobody goes to work there anymore, which is true. The firm has gone completely work from home, and they do back a single asset deal, a 2015 BBCMS 2015 MSQ, which is 1355 Market Street. And Twitter has about 75% of the space on leases that end periodically over the next 7 years. And that too is one to watch for CMBS investors. Since then, I mean, that isn't even the end of the story. You know, Musk came out and said he wanted to buy the company and put out a formal offer, which was very quickly rejected by the firm. So a lot going on there. I'm not sure what to make of it all, but if you're a CMBS type, it's that single asset deal to keep an eye on as this plays out. If they put a homeless shelter in there where Twitter used to be, it might be time to sell that bond.
There's actually some chatter today. There could be some winners from this. If Musk buys them, I'd be willing to put some money down that they move their corporate headquarters to Austin, where he has Tesla and everything else. So the Austin office market is kind of hoping that this goes through because Twitter could potentially relocate there to Austin, which is already supply constrained, seeing significant rent growth, et cetera. Austin a few years ago actually built a homeless shelter right in downtown because that's where the homeless population was. And I'll tell you, it's been a challenge for office dwellers down there. So, you know, I know he's making these comments tongue in cheek, but beyond just this one building, that could potentially have some consequences for the other office dwellers in that marketplace. I'm fascinated by this. I know we're kind of low on time at this point, but Musk is he's playing chess when everyone else is playing checkers, and I don't know what the end game is here. It's interesting to see him move the markets. It's interesting to see him drive the dialogue and conversation and do the things that he does just as a single entity and single person. Like with a lot of these high profile people, you know, you feel like when they speak or when they do stuff, it's on the advice of their, you know, really high paid advisors and so forth. And with Musk, it feels like he just woke up this morning and said, yeah, I'm going to buy this company, and then puts the narrative out there. It's interesting to live and see somebody. He's like a modern day Renaissance man. Don't know if I'm a supporter all the time what he does, but I'm just fascinated by his position and take on a lot of different things.
The lack of filter is somewhat refreshing. I sometimes lack that filter too, but we always have Haley Keene behind the glass to make sure that filter is put back in before this podcast goes live. And I can't tell you how grateful I am that we have Haley behind that glass.
Haley's the filter, helps us out. So we're going to move to retail. We covered a lot of office ground, and we're going to try to cover some retail ground, a couple of industry specific stories before we get into the hits. Green shoot, UBS analysts are saying that we won't see as many store closures as they had originally predicted about a year ago. If you recall, last year, their estimate was as many as 80,000 stores were expected to close in the next 5 years. They've downgraded that to 40,000. Still sounds like a lot, but not as bad as they had originally thought. And on the Crabgrass side, Manus, we've talked about this. Theft in retail is a real problem, and it's becoming more of an issue actually for the bottom line.
Yeah, I'll take those in chronological order. On the UBS side, I will take the under. I think that 40,000 number is way too high still. You know, we said a year ago that the era of big store closing announcements is over, that if you didn't throw back the keys or try to get out of a lease during COVID, it means you believe in that property, you believe in that lease. And yes, retail operators will let leases end and not renew. That will happen in trickles. But other than the drugstore side, I think that these days where you say JCPenney saying we're closing 200 stores, or Kohl's or Macy's or Best Buy, I think those are largely over. And if you turn the number around for UBS and you say 40,000 over 5 years, that's 8,000 stores a year. That's something like 800 a month, something like that, 700 a month. That sounds like an awful lot. I'm not seeing it. Like we read the headlines every day. We're constantly looking for this data. And unless they're talking about really small stores that are not even chain centric, right, that are mom and pop video stores or something like that, unless that's in their number, I think that 40,000 is way too high.
Yeah, I would agree with you, Manis. I think it has to include those like just tenant, type of stores that are going out inline space or whatever, because to your point, the math just doesn't add up. I don't see how you get to even 40,000. Although if they did, that would be dramatic. I would have to say there'd be ripple effects to the retail industry. Even if they got to 40,000 stores closing, like we would be hearing about that. I just don't see. COVID should have been the great equalizer. I think businesses were forced to right size their footprints. They were forced to right size their logistics. Bed Bath and Beyond maybe is the outlier there. We talked about them earlier, but for the most part, if you weren't going to make it or you couldn't make it during COVID, then you were going to be out of business today already. If you could, I think the prospects for your viability into the future have to be pretty positive.
Yeah, I mean, the only thing that could change this narrative is really Martha's point number 2, which is the retail theft, which was a front page article in Barron's either this week or the week before, combined with other things, right? That we enter a whole new phase of retail where the cost becomes so prohibitive between higher labor costs, higher security costs, higher energy costs, and supply chain constraints that the business model completely breaks. My thesis is, again, that for 24 months, if a company hasn't gone bankrupt or hasn't thrown in the towel, they're not planning to on particular property types. If I'm getting to 40,000, it's because these other 4 parts that we just talked about on the expense side just completely break the market. Not out of the question, but I hope that these things like supply chain issues, inflations, we wrestle to the ground over the course of a year, and they're not something that are endemic to the U.S. economy.
So let's go into some crabgrass and green shoots in the retail space.
Yeah, we saw a lot of really nice green shoots this week and a couple of crabgrassers. I'll run through them very quickly. My favorite was another trading alert we sent out today. The Mall St. Matthews in Louisville, Kentucky. It backs a $160 million CMBS loan, which is part of CMBX 7, the heavily watched retail component sister to CMBX 6. As I said, the loan is $160 million outstanding. The property value, just $83 million. So this was almost $80 million underwater. It's a former GGP loan absorbed into Brookfield a couple of years ago when Brookfield bought the GGP franchise. It seemed ripe for the towel to be thrown in. Special servicer notes have been talking about a deed in lieu for a while. And yet this month, the loan was extended to 2025. Brookfield is putting $7 million more into the property to refresh the capital base. They just got JCPenney to renew there. JCPenney is a top collateral tenant. So this might be the greenest of green shoots we've seen, something with 50% negative equity getting extended and the property owner betting that this mall is worth saving. Good on them. Number 2, the Ala Moana Mall in Hawaii was refinanced. It's a giant of a mall, 2.4 million square feet, built in 2 different parts, a 2012 part, and then an expansion in 2018. In total, 2.7 million square feet. Why was this so exciting? Well, one, Hawaii was considered as almost ground zero of what was going to be a big implosion of retail with no travel from the US, no travel from the Far East, heavily dependent on tourist travel to keep their economy going. In this particular case, it backed 2 CMBS single asset deals, a 2012 and a 2018. The value of the collateral when those loans were made totaled $3.7 billion. On the refinance, which was securitized a couple of days ago, that deal priced on April 7th, the mall was valued at $700 million more than it was valued in 2012 and 2018. So we see about a 20% value appreciation coming out of COVID. And again, just like Mall St. Matthews, just a wonderful green shoot for the recovery of property values in the retail segment.
Yeah, I think the Hawaii Mall was a really great sign because that's kind of a marquee property. It's a one of probably top 5 or 10 malls across the US. It has some additional challenges being on the island, limited travel, et cetera, et cetera. To see it lose, Neiman Marcus, still have, a refinance appraisal in excess of what the previous 2 were is really, really great. For users of our platform, this is a really great data set because we actually have, underwritten financials on this deal from 2012. We have the underwritten financials and, actual in-place financials on the extension in 2018. And now we'll see what those rental rates look like on the refinance in 2022. So this is one that, we have a really deep history of, so you can actually see in real time, what those impacts, if any, have been to the inline space tenants on a rental rate per square foot, occupancy cost, and inline sales. So interesting to see when that deal actually comes online, and we have the paper on that to see what was utilized. But just anecdotally, these malls that seem to be doing well, it seems like they're collecting rent up at 90+% of the tenants. So I'm interested to see when we actually get the deal docs on this one to read through that and see what it's doing. But the appraised value would indicate that this mall is doing very, very well.
And very quickly, 2 Crabgrass stories. One, we talked about this in our Tripwire earlier this week. A story we're watching play out is Rite Aid. One of our Twitter followers reached out to us privately and pointed out that their corporate debt is trading at 71 cents on the dollar, which is kind of in the deep discount bin. It's not at the 20 cents on the dollar level, which would be kind of the pre-bankruptcy level, but at 71 cents, it's a concern. The stock price plunged this week. They have been closing stores. I don't think bankruptcy is imminent, but if this trend continues, you can't consider it out of the question. And we bring this up because Rite Aid is the single tenant behind many, many CMBS loans in that $3 to $10 million size range. Normally, those are credit tenant leases, and Rite Aid is the obligor under the lease. Often these leases have 20 years to go, which sounds like a great place to be. But if they do file for bankruptcy, if they were to, they'd be in a position to reject these leases, and you'd have a single tenant where Rite Aid could close the store in a month with very little warning. And as we've noted in the past, we do seem to be over pharmacied in the US. It's one of the areas that has been closing stores in the last year or two and will continue to do so. The other Crabgrass, not a real big surprise, the Destiny Mall in Syracuse, it backs $430 million in CMBS debt. It went back to special servicing. It's slated to mature in June. It is about $90 million underwater on an equity value basis. The owners pyramid have really been fighting to keep this thing. Occupancy, I think, is 60%, 62%. Good on them for fighting for it and trying to keep this thing going. I hope they win that fight, just like GGP/Brookfield did. But it's a big single asset deal that bears watching for investors.
And we are going to be running out of time, but I do want to talk a little bit about a piece that we're going to be putting out next week on multifamily. We've looked at multifamily stories unfold that have to do with eviction moratoria, falling revenues, and rising expenses. So what we wanted to see was NOI performance in this sector. What did we see?
Thanks, Martha. This is, again, the work of a couple of guys at TREP that I've given shout outs to before. John Flanagan in our bond modeling team and Max Nelson in our marketing and research teams did some great work here. What we did was we went through and looked at all of the Freddie Mac loans for which NOIs were reported both for full year 2020 and for full year 2021. At this point in the cycle, only about 20 to 25% of the loans have reported full year 2021 financials, but we thought that that was enough to give our listeners a sense of what we've seen. You could take them for what they're worth. We will do an update to this in a month or two once the numbers are closer to 100%. There'll be a big piece that we put out about this, authored by Max, sometime in the next week or so. The non-surprise to me was that the Southeast and the Southwest really outpaced the rest of the country when it came to NOI growth. No big surprise. We've seen a real migration to the Carolinas, to Alabama, Florida, and so forth. So that was one of the areas where we saw the biggest NOI growth. I think the big surprise for me was that the NOI growth wasn't bigger. I think nationally, we saw about 4% year over year NOI growth. And considering how much people are paying for properties, and considering that NOI, you would think in 2020 was depressed in certain markets by people not paying their rent, that this would have seen a much bigger jump in 2021 than what we saw, which was overall nationally just a low single digit NOI growth. So more to peel back as time goes on, and it's a very interesting report.
Yeah, I think a takeaway here, man, is the subset of data that we looked at maybe was a precursor to that low single digit NOI change. By definition, the Freddie property should be stabilized. So you're going to see just organic rent growth on the revenue side, and then that trailing down to NOI growth. I think if we did a similar analysis on the CRE CLO market, where those are value add reposition type of plays, you're going to see probably a mid-teen, low double-digit type of NOI growth on those. The challenge in doing that research on those is that upon origination, those things are not stabilized, so they have a really low NOI in some cases. But I would say, so like I'm maybe less surprised after thinking about this that the Freddie numbers were not 10+%, just because those properties by definition were stabilized at origination with really no value add or reposition other than just trying to harness that, organic rent growth.
Well, Lonnie, you've talked about this before, that NOI doesn't reflect revenue growth. And before we got on the call, when we were doing our prep before, you talked about how the growing expense side is really being underappreciated in this whole thing. Why don't you tell us a little bit about that?
Yeah, so, as we see every week on our podcast, you guys hear us talk about record sales prices. Those record sales prices translate generally into a reassessment of the property from a tax perspective. So, immediately upon sale in a lot of jurisdictions, you're seeing a large uptick in property tax assessment and actual property tax line item expenses. Those are very difficult to contest. Everyone has professional consultants to help them with those efforts, but that's an increased expense that, gets baked in at some level. Repairs and maintenance, insurance, utilities, all these things that we've talked about from an inflation perspective, those are very real for these operators. So materials are costing more, labor's costing more. So to your point, Manus, if the headline rent rate growth is 15%, you're not going to see a 15% growth at the NOI line, especially in this market. The two run hand in hand. So 15% rent growth, you maybe get a 6 and 8% increase at the NOI, just because those costs that we talked about are also going to be increasing. Now, this is where you have some alpha though in the marketplace. If you have scale, if you're a large developer or a large management company or a large operator, and you're getting labor and insurance and taxes and those things managed better than the market, then you may be able to pass a little bit more of that rent growth into the NOI. But for folks that are regionally based, maybe have a handful of properties, they haven't quite hit that critical mass on the scale side, they're not going to see that direct correlation between revenue and NOI.
Yeah, I'll throw two things out there. One is, if you'd like to engage with us either with Twitter or through email, I'd love to know from our listeners if the kind of NOI growth that we've seen justifies the valuation growth that we've seen over the last 2 years and the cap rate compression. I'd love to get alternative points of view out there. And just to mention this separately, Lonnie has enormous amounts of data on the expense side of commercial real estate properties on all property types, not just multifamily. So if you're an owner out there and you want to benchmark how your expenses look to the rest of the market, Lonnie's your guy.
Yeah, we'd love to talk to you in those instances. We have some really cool tools that actually are pre-built for benchmarking. So if you operate, any number of multifamily or retail facilities or office properties, we can give you 5, 10, 15-year benchmark averages by line item expense. So definitely reach out if that's of interest to you.
And so turning to shout outs, we had some new shout outs this week. George H. wanted more information on the West Palm Beach apartment to hotel conversion and loved the podcast, said to keep it up. Brad C. sent us an April Fool's message. I think that was for you, Haley. He was having some fun with you, but he tries to never miss an episode. The LSU Department of Finance. That's one we have not gotten a shout out from before. Brian A. shared episode 130 and said they are assigning the podcast to their CRE finance students. So once again, shaping young minds as they get encouraged to listen to the podcast.
Shaping, corrupting, whatever.
Yeah, exactly. Adrian S. reached out to contact Matt Anderson, who did a deep dive on interest rates a couple of weeks ago. And Adrian said they're a frequent listener and appreciate the expertise and insights from our discussions. Rob J. mentioned he's a favorite listener as well. BB Dogged, who we mentioned before, actually had a couple of comments. He commented on the crabgrass we had last week on the Westfield shedding asset story. And Markets Junkie asked, where's my favorite boomer? Of course, Manus, he was referring to you because, well, Lonnie and I'm not sure if we're favorites or boomers.
Well, it's funny. I threw out a slang term the other day when I was walking around my kitchen with my wife, and she said, you may be a boomer, but you're still a 15-year-old boy, and in your mannerisms, your dress, your act, what you listen to, and the way you speak. So I don't know if that's young at heart, which I like to think of, or just, a boy in a man's body. I'll let the audience weigh in on that.
I think that's a compliment. I'm gonna say that's a compliment. You should take that.
I'm not sure it came that way, but yeah, why not?
You should take it that way. And Steel City Dave gave us a shout out. We haven't heard from him in a couple of weeks or so. He commented on Andrew Jacobs' chic undergarments. I'll leave it at that. And Lonnie's rapping Snoop Dogg. And once again, I don't know if I call that rapping, Lonnie. It's more like reciting. And if you've waited to do your taxes this year, guys, you can wait just a little bit more. This year's deadline is not the 15th, but guess what? It's Monday, the 18th. And you can thank the IRS for Emancipation Day falling on Friday. So you get more time to file your taxes. And by the way, if you're looking for a job, the IRS is hiring like a lot of people, 10,000 people in the next 5 to 6 months. Just saying.
Yeah,
I'm not interested.
I hope that they load up on people that just don't look that closely.
Write some checks, please. And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send your note to podcast@prep.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.